The broadcast is now starting. All attendees are in listen-only mode.
Good day, ladies and gentlemen. Welcome to a Standard Bank webinar hosted by SBFC, which is Standard Bank Financial Consultancy. My name is Ketwe Gunene. I'm the coordinator, but I'm not the person sitting on the hot seat today. We've got two presenters that I'm going to introduce to you just now. But before I do that, I want to make sure everybody is comfortable and everybody knows how the setup works. For those of you who are new to the webinar situation, I just want to introduce some few things to you. First of all, make sure your sound is turned up to full volume. On your taskbar at the bottom, if you find the volume sound, just put that all the way up so you can hear us clearly. You will be muted during the discussion. So when you see mute on your screen, it's because we don't want anybody disturbing the presenters. Only the presenters will be able to vocalize, which leads me to the next point, questions. You are allowed to ask questions during the presentation. It's easy to do that. On your right-hand side of the screen, there's a panel. Find the title that says questions. Under that title, you can type in your question. Anytime during the presentation, we will see it during the presentation on this side, but we'll only pose the question at the end of the presentation to our presenters so that we don't disturb their flow. Second thing as well, this is going to take about 50 to an hour, so you can relax, make sure you've got a good connection. The presenters will then take questions at the end, like I said, and then give you the answers to that. Okay, so the two presenters today, we've got Mr. Errol Meyer, we've got Mr. Kevin Lings. Errol Meyer, you might know very well. He sits in on most, if not all, of our webinars. Errol is a certified financial planner and an advocate of the High Court. He holds qualifications in finance, law, teaching, and taxation. He's authored a book. Those of you who've done CFP know about that. He's a renowned lecturer, examiner, and moderator for various universities in South Africa. And he currently holds the position of head for advisory propositions at Standard Bank. So welcome to Mr. Errol Meyer. Our second presenter is Mr. Kevin Lings. We're very excited to have him today. It's our first time having him here at Standard Bank to present for us. Kevin has been employed as the chief economist at Stanlib since 2001. Over the past 10 years, the scope of his economic research has broadened to include the G3 economies as well as members of the BRICS. His research is largely used to inform Stanlib's asset management investment process. While at Stanlib, Kevin has managed an asset allocation unit trust fund for 5 years, winning the Micropulse Best in Sector award. He's completed his undergraduate and postgraduate degrees in economics from the University of Witwatersrand, which is WITS, specializing in public sector finance and international trade. Although the missing piece is Kevin's first book of the South African economy, he has published a number of journal articles, both domestically and internationally. And just on the side, besides a passion for economics, Kevin is a keen photographer and also an avid horologist. So he is a very well-rounded and interesting human being, which is why we have him here today. So gentlemen, I'm going to get off the hot seat. I'm going to say hello to you guys. You can say hello together. And then Mr. Errol Meyer will head off the presentation for us. Good day, gents.
Thank you, Katiwe.
Hi, good morning.
Good day to all attendees and welcome to our webinar today, hosted by Standard Bank Financial Consultancy. Goals-based estate and financial planning requires understanding of market forces so that we plan correctly for our future financial and lifestyle goals. But things are not always that simple because of uncertainty as to what the future holds. Very often a degree of certainty is found in analyzing the possible uncertain, yet sometimes predictable events and make a decision that will ultimately impact on our future plans. Now, the concept of scenario planning plays an important role when formulating an estate and financial plan, and knowledge of the economic outlook fulfills such an important part in the planning process. It is therefore important to understand the relevance of the happening of certain events in South Africa and worldwide economy. In this presentation, Kevin will discuss various such events, such as the Trump factor in the United States and ultimately the South African economy. South Africa has its own unique makeup and unique events. Now, only last week, the Davis Tax Committee made public its anticipated recommendations on a proposed wealth tax. However, there is no doubt that no discussion of wealth tax, which is intended to restore the unequal distribution of wealth in South Africa, can really be implemented before we solve our problems pertaining to corruption, being subjected to poor leadership, and then have certainty on discussions around the necessity to change Section 25 of the Constitution to facilitate land expropriation. Also, what is the nature of land that is targeted, and when one starts looking beyond the emotional issues, and when stop comparing to what happened in our neighboring country, one may just be surprised with the eventual outcome for later years to come. Some very positive developments are happening, such as the Cyril Ramaphosa economic turnaround plan to attract foreign investment, conscripting 4 ambassadors from the business sector into national service. This international sales pitch will include former Finance Minister Trevor Manuel and Jaco Maree, proudly our Standard Bank CEO. This may just restore so much needed confidence in our economy. However, in our everyday world, we also have a keen interest in the economy, since many of our financial planning strategies depend on interest rate fluctuations. For instance, a decrease in interest rate may improve cash flow for a household to allocate more funds towards savings. Now, inflation is the enemy to beat in any financial plan. Therefore, financial goals such as future education, retirement, post-retirement medical expenditure are all directly linked to outperform inflation until we reach our financial planning goals. As a matter of fact, our goals-based investment portfolios are suitably constructed to reach such short and long-term goals with the minimum risk and highest possible returns, and they are all balanced against the inflation rate. Goal-based financial planning and investment strategies are all about having to beat inflation over a certain term to enjoy our future lifestyle goals. And now I will hand you over to Kevin to take us through his presentation.
Thanks a lot, Errol. Afternoon, everyone. What we're going to do today is we're going to discuss, I guess, 2 particular areas of the economy. The first is to get a sense of where the US is at. What's happening with Trump? What is he trying to do? How's the US economy performing? And the reason for that is that in the financial investment world, the US has a huge impact on market sentiment. We get lots of questions that says to us, why do we focus so much on the United States? Why do we spend so much time analyzing developments with regards to Trump and policy and tax and interest rates? The reason is very simple. It is the single biggest factor influencing the performance of the South African market, other than our domestic economic events. So we need to understand what is happening in the United States, and we would follow that very, very carefully. So I'm going to go through a discussion on the US. We'll follow that with a discussion on South Africa. Generally, the feeling around South Africa is more positive. There's a higher degree of optimism. Most people are revising up their growth estimates. But there are some concerns. And one of those concerns clearly relate to land and land expropriation. So we're going to spend some time towards the end of the presentation talking about land, and I'm going to try and provide some context in which this land is being discussed. And I must say that when you get closer and closer to the topic, and when you engage more fully with people within the policy area, including within the ANC, I've certainly become less anxious about it. And I think it's been a little bit overhyped in the media. And I think there's a lot of scare statistics and a lot of scare suggestions around land expropriation. My sense is that the reality is nowhere near as concerning. So I'll take you through some of that discussion. And then when we finished all of that, hopefully there's some time to answer some questions. I've already got 1 or 2 questions, mostly related to land. So we're certainly going to focus on that through the discussion. But if there are any other questions relating to policy, relating to interest rates, inflation, anything like that, just send them through and we'll see if we can get some time later on to discuss that. Now, before I talk about the United States, I just want to make this point about the world economy. And in my head, this is unbelievably important. In the last while, there's been an increasing discussion driven, unfortunately, by President Trump around trade protection. And that has led to a concern about what's being called a global trade war. Now, from Trump's idea, what he's trying to put across is a notion that says the US loses out in the global trade arena. That the US provides favorable access to many countries if they want to export to the US, but the US in turn doesn't get favorable status in trading into those other countries. And so from his perspective, he wants the United States to have what he would call a better deal. Now, he's focused on three countries in particular. The one is Mexico, the other is Canada, and at the moment it's China. And the reason he's focused on those three countries is those three countries are the largest trade partners for the United States. And he obviously feels that he can extract a better deal for the US. Now, that may be fine for parts of the US. The problem is, what do those countries do in response to that type of antagonism? And the risk is that if China responds more aggressively and starts to also restrict trade from their perspective, the net result would be an escalation in trade protection, and the consequence of that is a global trade war. Now, when you look at world economic performance, over the course of the last, let's say the last 12 months, the last 18 months, there's no doubt that the world economy has accelerated. Growth is now above the long-term average. You've heard more and more discussion about the so-called synchronization of world growth, and it's been actually a very good phase for the world economy. But that phase of better growth has been driven by an increase in trade volume. So if you look at the chart on the screen, what it's showing you is simply the growth in trade in volume terms over a number of years. And what you'll notice is in last year, global trade was growing at around 5%, and that compares with, let's say, an average in the preceding few years of around 2.5%. Now, that acceleration to 5% is very meaningful. And once global trade is growing that fast, many of the smaller countries start to benefit, including South Africa. So what we find in South Africa is if global trade is growing at, say, 2.5%, there's not a lot of benefit for us. But once global trade's accelerating to 5% or higher, we get drawn into that environment and we start to benefit. And during the course of last year, South Africa was able to generate a very substantial trade surplus. So there's huge benefits. So we need to watch that carefully. At this stage, it feels as if there's some backing away from this trade war. There's some easing of tension. And partly that's because I think Trump has been more forcefully advised not to embark on further trade restrictions. But it's something we need to watch, and it would have significant implications for South Africa and implications for the world economy. So if you look at the chart on your screen, there's a strong link between the growth in world trade and what's called global industrial production. Industrial production is simply manufacturing. And what that says is that if global trade accelerates, global manufacturing accelerates. Once that happens, the world economy will feel much more vibrant. There's much more employment, much more value being added, earnings do better, there's more profitability, it's a good phase. So what we don't want to see is a slowdown in global trade and therefore slowdown in global manufacturing. It would have significant implications for South Africa at exactly the wrong time, at a time when we're trying to lift our economic growth. So just be aware of it. It's something we're watching. We're hoping it doesn't manifest more fully. All right, so let's turn our attention directly to the United States. And obviously, Trump gets a huge amount of airtime, most of it negative. If you listen to celebrities talk about Trump, they've got nothing good to say. If you listen to some of the financial press, maybe the Washington Post, New York Times, CNN, they certainly are fairly negative on Trump. But you've got to be aware that not everybody feels the same. And if you look within the United States, there's a lot of optimism about what Trump has done, and there's a lot of confidence that Trump is moving the US in the right direction. So we've got to be aware that we can't really form an opinion about Trump and his policies just based on the media. We need to look at it a little bit more carefully and understand what some of the data is doing. In terms of the US economic cycle, it's been growing now for 106 months. So remember, the world had a financial crisis in 2009, a global recession. We came out of that recession in 2010. Most of the world started to recover, including South Africa. And effectively, the United States and the world economy has been growing consistently since 2010. For the US, a total now of 106 months. And in the last, let's say the last year, there's been a noticeable acceleration in the US leading economic indicator and an acceleration in US economic growth. So it remains a good phase. Where we are debating this economic phase, though, is we realize that at some point, the US economy will lose momentum. Economies don't go up forever. They don't continue to expand forever. There's still a business cycle, and at some point in the future, the US economy will start to lose momentum. So we spend a lot of time trying to understand, when will that occur? What are the factors that could lead to a slowdown? Hence our worry about global trade and trade protection. But as it stands at the moment, in terms of the data that we see, there is no sign that the US is about to lose momentum, that the world's biggest economy is going to go through a slump. There's no clear indication that that is happening. In fact, quite the opposite. Right now, growth rates are being revised up. The IMF revised up the US growth forecast. So the data looks compellingly good. That doesn't mean we are not aware of the risk, and we need to be mindful of that, because this won't continue on forever. So let's turn our attention to two areas within the US. The one is the consumer. It makes up 70% of their economy. Think of the United States as one big shop. And if the US consumer is happy and shopping, maybe taking a little bit of credit, being employed, the US economy will do well. So when I look at the consumer and some of the data, geez, it looks good. Consumer confidence has moved up convincingly since Trump was elected. In other words, in simple terms, people in the US, your average household, is happier now that Trump is the boss than when Obama was president. It sounds odd when you look at what the media are saying, but confidence is at a multi-decade high, and it's moved up convincingly since Trump was elected. So the reason for that confidence move is not entirely due to President Trump. There are a number of key economic factors that have supported the consumer. The first is that employment has been rampant. The US employment is at an all-time high. They employ something like 147 million people. The important thing is, since the financial crisis ended in 2010, the US has now added more than 18 million jobs. That's phenomenal. That is an average addition of around 200,000 jobs a month. It doesn't mean they add 200,000 jobs every month, but on average, it's 200,000 jobs. And they've continued to add those jobs for over 100 months. So if you look at employment, it's 9.8 million above the previous peak. That employment has occurred in every single sector within the US, with the one exception, and that is government. During this time of strong growth in employment, as has been dominated by private sector employment, not so much government, which I would argue is good news. But within the private sector, all sectors of the economy have seen an increase, including things like mining, agriculture, financial services, employment, incredibly broad. And once people get a job, we know that their confidence levels go up. So this has been a massive contributor to the overall level of confidence. One of the interesting dynamics around the US labor market is the number of what we call job openings. Now, job openings, if you look at the chart, is in purple, and that number is now just over 6 million. And in simple terms, what that means is the US is currently advertising for more than 6 million jobs. So if you take all of the job advertisements, either in press, online, wherever, a record number of jobs being advertised across almost every sector of the economy. There are a couple of areas where job advertisements are higher. So, for example, in the healthcare industry, there are currently more than 1 million jobs being advertised. If you look at what they call business services, which would include financial services, Again, there's more than 1 million jobs. But there's a lot of jobs being advertised in retail space, pretty much every single area. The interesting thing about the job advertisements is if you look at the blue line, the number of people unemployed has systematically fallen to the point where it's almost equal to the number of job openings, which means the labor market in the US is getting tighter. Obviously, you can't simply fill all the vacancies because of skill shortages, location differences, etc. And what it's starting to show up is that the US companies are struggling to find skilled workers. And we think that that will ultimately result in higher wages and therefore give some buoyancy to the US economy. Just an interesting dynamic to pay attention to. The other factor that has helped the US confidence is house prices. During the financial crisis, US house prices fell dramatically. It was at the heart of the financial crisis. But if you look at the performance of house prices in the last few years, they've systematically moved up to an all-time record high. It doesn't mean that every city has record prices. I looked at prices in Las Vegas. They're still below the all-time high. But the broad range of US cities now have record house prices, and they continue to rise at about 6% a year. And there's no doubt that if you've got a job and your house price keeps going up, then generally you're going to feel a lot more confident, a key factor supporting the household sector. The third element is that the US household sector is now the wealthiest they've ever been. Obviously, they lost wealth during the financial crisis, and if you look at the chart very carefully, try find 2008, 2009 on the chart. That was the financial crisis, and you can see the loss in wealth. When we look at it now, it doesn't look all that dramatic. At the time, it was a major event. What has happened since then is obviously the equity market has recovered and went to an all-time record high. The property market has recovered. The consumer hasn't taken on a huge amount of debt. So if you consolidate your debt or control your debt and you're investing in equities and you've got a property, over time you're going to become wealthy. And that's exactly what the US household sector has experienced. So their total wealth is now $99 trillion. Phenomenal, all-time record high. Now put all of it together and you can see why consumers are confident. They've got record number of jobs and jobs are available. They've seen their house go to a record high. They've seen their equities go to a record high. They're the wealthiest they've ever been. The US consumer is in great shape. Given that that is 70% of the US economy, it's providing a very nice underpin. And that should continue as long as the politicians don't mess it up. And we know that from time to time politicians do crazy things, and that ends up being the single biggest risk facing the US economy, is at some point President Trump does something to derail this very good news story. Okay, let's turn our attention to the business sector in the US, and there we see the same sort of performance. Believe it or not, business confidence is back at a record high. Obviously, during the time when Obama was president, business confidence was a little bit below average. The reason is that Obama focused a lot on the social dynamics of government, not so much on supporting the business community. So Obama did a lot of stuff to develop the healthcare industry. He did a lot of stuff to increase unemployment insurance. But when it came to the business sector, he tended to introduce more regulation, including environmental protection. He tended to not provide the business sector with a lot of financial support. Along comes Trump, and what he did was to talk directly to the business community and talk about how he was going to support business through tax cuts, deregulation, etc. And the business sector loves that. So in the month after Trump was elected, business confidence went up the most ever recorded. And since then, it's remained at an elevated level, which tells us that the business sector is fundamentally in better shape than it was a few years ago. Now, you can see some of that in the tax cuts and why the business would be a lot happier. So remember, once Trump was elected, he spoke about tax cuts. He spoke about tax cuts before he was elected. And I guess many people thought that he would not be able to follow through with that type of promise. As it turns out, he cut corporate taxes. Those are it came into effect from the beginning of this year, so this is not a discussion, this is reality. And corporate tax rates went from 35% in the US down to 21%. That's a massive cut. Trump was actually initially wanting the tax cut to go down to 15%. In the end, he was persuaded to back off from the 15%. They settled on 21%, but it's a huge benefit. It clearly is going to uplift company earnings, and it may well entice companies to start to undertake a little bit more investment. It's not as if he only cut the corporate tax rate. He also cut taxes for individuals. Yes, more the wealthy individuals than necessary low-income earners, but it's a comprehensive tax set of measures. And the idea is that this is designed to boost particularly corporate activity and corporate investment. So when you look at industrial production in the US, manufacturing, it's going through a revival. And that revival, part of it can be credited to Trump. Not all of it, but certainly Trump has been more supportive of industry within the United States. And right now, manufacturing is employing at a faster pace than they have done in decades. At the same time, we've seen companies undertake much more investment. And we watch something called durable goods orders. Now, it sounds like a boring topic, because it is, but when you look within durable goods orders, it represents companies undertaking investment in machinery and equipment. In other words, when this number starts to increase, it simply tells us that companies are ordering more machinery, more equipment, more technology. And companies would only do that if they're confident and they're looking to expand. And right now, the data has accelerated, suggesting that as long as the politics remains okay, as long as the issues around the trade wars remain contained, the business sector should expand further. So take where the consumer is, consumer confidence, add that together where the business sector is, the US economy, the world's biggest economy, in good shape. The last two things I want to mention on the US, the one is the impact of military action. Now, bizarrely, when you go around blowing up other countries, it actually boosts your economy. So have a look at defense activity over time and look at the contribution that made to the US. So go back to the year 2002, 2003, the United States decided to blow up Iraq. You can debate whether that was good or not, but what it did do was it boosted the US economy, and at its peak, it added 0.5 percentage point to US GDP growth. What that means is, let's say you're growing at 2%, you blow up Iraq and you're growing at 2.5%, a very meaningful uplift. Now, the issue with that is that it's not the best way to lift your growth rate. It's very expensive, it's very inefficient, and obviously we hope it's not sustainable. They went through a lull and then they blew up Afghanistan, and when they blew up Afghanistan, they added another 0.5%. So this type of activity can contribute to your economic performance, but we need to stress it is not ideal from a whole range of reasons. Obama then gets elected, and if you look at defense activity through the 2013, 14, 15 era, it actually detracted from US economic activity, and that's because Obama was more intent on controlling the military budget and certainly not entering into any conflicts. Now what you've seen in the latest data is a revival of US military action. We see that in the Syria bombing, but other activities. And in all probability, you'll see a bit more defense contribution. I need to stress, though, that over time, while this contributes to the economy when you're going through this action, it ultimately undermines the confidence in the global economy. It undermines the efficiency of spending within the US government activity. It's not something to be applauded. It's just something to be aware of, that it does make a difference to how the economy performs. The last thing on the US just to mention is inflation has now finally in the US gone above 2%. Their core inflation slightly above 2%. They target more or less 2%. And at this point, you would say inflation is thereabouts in terms of the target. So what you would anticipate going forward is that the US will systematically continue to hike interest rates. They've already started that process. I think they'll continue on. We think hike rates another 2 or 3 times this year. They'll follow it up with a further rate hikes next year. I don't think it's too problematic. I think it's manageable, but it is going to set the tone for global interest rates over the coming 2 years. And so we've got to be aware in South Africa that by the US hiking rates, it limits our ability to cut interest rates. We can't allow the gap of interest rates between ourselves and the US to narrow too much. Once we do that, it makes it more and more difficult for South Africa to attract foreign investment. So the US sets the scene for global interest rates. Doesn't mean we can't cut rates. I think there's still an opportunity, but we've got to be mindful that the US is on a rate hiking cycle, and it does impact the investment world and global capital flows. All right, that's all on the US. So let's turn our attention to South Africa. The South African story certainly feels a lot better. I think that was to do with the election of Cyril in December. I think that was a significant change. That was followed up by what I thought was a very good State of the Nation address in February. I also thought that the government presented a solid budget, national budget, where they clearly are now trying to adhere to fiscal discipline. I would suggest that was followed up by the decision by Moody's to keep South Africa's credit rating at investment grade. In fact, they even revised the outlook for South Africa's credit rating from negative to stable, which is a very positive conclusion. And then more recently, as Errol mentioned, the government has appointed 4 key ambassadors to try and lift South Africa's profile in the international investor community and try and raise some foreign investment flows. But I think it's an important step in the right direction, especially when you consider the people that they've nominated to that panel. I think they're all very credible, and I think they'll do an excellent job in promoting South Africa. And the fact that Jaco Marie's on it, I think, is a huge vote of confidence in Standard Bank and in Liberty and in the types of talent that the bank is able to produce over time. So the backdrop, I think, is much more positive for the country. Now, when we look at the growth outlook, most people have revised up their growth estimates. We've taken our growth expectation for this year to 1.5%, and we're saying next year we can come close to 2%. Now, 2% is still not enough, but relative to the growth rate we've achieved in the recent years, it is a helpful uplift. When we go back earlier, let's go back to, say, 2005, 2006, and look at the chart in terms of the average growth rate we achieved before the financial crisis. And what you'll see is that average was 4.2%. And we forget that. We forget that South Africa enjoyed very solid, very consistent growth for a number of years. It wasn't 1 or 2 years fleeting growth. It was pretty much a decade-long growth where we average in 4.2%. And South Africa needs to go back to that era. That type of growth is really what we're after. And if you look since the financial crisis, we've enjoyed growth of only 2%, and obviously it's been weaker since then. Anyway, as it stands, we expect some uplift, and I just wanted to share with you where other forecasts are on GDP. So our numbers are for some uplift, but have a look, maybe I know the table's got a lot of numbers, but have a look at the end of the table, and we've got up the forecast from the South African Reserve Bank, the National Treasury. I've put in Standard & Poor's, the credit rating agency. They like us now. I've got World Bank, I've got Institute of International Finance. All of those numbers have been revised to the upside. Everybody, including the IMF this week, revised South Africa's growth up. All of us expecting growth to move closer to around that 2% level. So that has to be applauded. What I want to just highlight, though, is 2% is not enough. The reason 2% growth is not enough is it won't create enough jobs to deal with the problem of unemployment. So at this stage, South Africa has around 6 million people unemployed, but more importantly, the trend is to the upside. And what we know from the demographic data in this country is that South Africa would have to add roughly 600,000 jobs a year in order to stop the unemployment rate going up. In other words, if we want this chart to move now sideways, we would have to add 600,000 jobs. That's a huge task ahead. The average age for South Africa is 24. Now, by world standard, that's incredibly low when you consider the average age in Europe is over 40. That means we have a huge number of people that enter the labor market every year, and we have to accommodate those. Otherwise, social tension and other problems will occur. So what growth rate would give us 600,000 jobs a year? That is more or less 4% GDP. That's why we're saying we need to go back to that era before the financial crisis when we averaged 4.2%. If we can repeat that type of average, then we stand a better chance of creating enough employment to stop the unemployment rate going up. Of course, 4% would not reduce the unemployment, the number of people unemployed. We would need growth in excess of 4%. But I think the short term or the medium term focus needs to be much more 4% growth than 2%. So in my mind, the 2% is an interim type uplift. I'm really asking myself, can South Africa do enough to get growth up to 4% over the next 5 years? I think it's eminently possible. I think Cyril is aware of that. And I think that we could change policy enough to generate that type of outcome. I'll chat about what needs to happen in a little while. Obviously, if we don't get these numbers, let's say that we only generate 1.5 to 2% and that remains the growth number over the next 5 years. What's the problem with that? One of the problems will be, besides the unemployment rate moving up, is the number of people that receive a social grant will continue to rise. So on the chart, you've got some numbers that reflect how many people receive a social grant every month. Now go back to 2005, and what you'll see is that 9.4 million people received a social grant. That has systematically escalated to the point where we're looking at this becoming 18 million people. That's a huge number. That number is in excess of the number of people that work. And if we don't create enough jobs, if we don't grow this economy at 4%, this number will continue to rise. And the implication of that is that government's budget will become more and more constrained. So what we need to ask ourselves is this question, and I don't see it enough in the financial press and in the general press. I see a lot of political discussion. I see a lot of racial discussion. I see a lot of debate about land. I see a lot of debate about which political party is right on what issue. But what I'm not seeing is a debate about how do we lift South Africa's growth to 4%? How do we achieve that? Now, the damage that we've done to this country over the last 10 years means that our options on how we get 4% growth are not what they used to be. We don't have the same choices. We can't make the same choices. So I just want to illustrate where the choice really lies. And in order to do that, I want to focus a bit on government. So let's answer this question. Could government spend more money in order to lift South Africa's growth? Could government on its own drive the economy to a higher growth rate? And the answer to that emphatically is no. The reason is, if government wants to drive the growth rate higher, they need more money. In order to play a pivotal role in the economy, in order to drive the economy, you've got to spend money. Government is systematically running out of money. Now you see that in the budget revenue numbers. And what I've got on the chart is that every bar that is in red, that indicates that government undercollected tax revenue relative to budget. And if you look at the last 3 years, government has systematically undercollected. Last 4 years, in fact, have systematically undercollected. And last year, the undercollection was in the order of 50 billion rand. That's huge. The reason it's important is that government budgets as if they're going to have 50 billion rand more, which means they spend the money. Having spent the money, you then realize, gee, I'm not collecting the tax revenue. So what is the consequence of that? You have to borrow a lot more. And so what we find is that government's role in the economy has increased and government's debt has escalated dramatically. So when you look at government expenditure as a percentage of this economy, it's gone from 25% of this economy and it's now approaching 35%. That means that over the last 10 years, government has played an increasingly larger role. Now, that's fine if you can fund it. Unfortunately, if your tax revenue is falling and your government is playing a bigger and bigger role, it means that government has had to borrow a lot more money in order to play that role. Now, add on top of that, the borrowing that has come about directly in South Africa's bond market, and what you've got is explosive debt. So have a look at the chart in two phases. The one is how much money did the South African government borrow in the domestic bond market before 2009. And what you'll see on that chart is that the borrowing was very little. It amounted to maybe 10 billion, 20 billion rand a year. In fact, there were some years where government borrowing was negative, which means in total government was repaying debt. Then in 2009, that changes, and it changes dramatically to the upside. Obviously, there you can see from the data that there was a decision made by government to become more expansionary, for government to start to spend money more aggressively after 2009. The problem from my perspective is that at the time, government said to us they're going to spend more money, but they're going to spend that money on infrastructure. And in fact, government put together a budget that said 826 billion on infrastructure spending over 3 years. In reality, government didn't spend the money on infrastructure. What they ended up with, yes, they spent a lot more money. Yes, they borrowed a lot more money. But the overwhelming proportion of that money went on salaries, government employment, and part of it went on social grants. And so you never got the infrastructure development, which means you never got the economic growth. As it's turned out, by borrowing this amount of money on a persistent basis, government's debt has increased dramatically to the point where the rating agencies were downgrading our credit rating. Now, this debt that I'm showing you in the chart excludes the debt that government has taken on at the state-owned enterprise level. In other words, it excludes debt from Eskom, it excludes Transnet, South African Airways, the SABC, all of the state-owned enterprises. You'd have to add that debt to this. In addition, this excludes the foreign debt. So let's put all of the debt together. What is government's indebtedness at a public sector level? Turns out that is now 70% of GDP. And at 70%, it's becoming unmanageable, and therefore it sets up us in an environment that will see further credit rating downgrades. So look at the purple bars that I've put on the chart. The purple bars are important because they tell us government's forecast for government debt. And what government is now trying to say is that we can't continue to increase the debt level. We've now got to try and hold the debt level contained. That is regarded as fiscal discipline, and that is partly why Moody's didn't downgrade us further. But once government says we're going to try and contain the debt, by definition, government can't continue to spend at the same pace they have in the past. So if government is not able to play an expansionary role in this economy, how do we lift the growth rate? How do we get the economy growing at 4%? Well, I would suggest we've got to look at the element of this economy that has mostly underperformed. Which part of this economy has been the weakest? And that, unfortunately, I'm going skipping over two charts, has been driven by private sector investment. If you look at private sector investment in the last couple of years, it has declined by a total of 12%. That means that private business has said we're not going to become expansionary. In fact, we're going to pull back on our investment. And it's got so severe that many companies are not even replacing the equipment that has now broken or is out of date or requires a technology upgrade. So this is the single biggest factor that has hurt the economy. And when your private sector is withdrawing, private business is withdrawing from the economy to this extent, it's very difficult to get an uplift in growth. Now, some people look at this and say, hold on, that means that if private business has stepped away, the role is for government to step in more and provide much more of the uplift. The problem with that right now, besides the fact that government doesn't have enough money, is to do with how we've been managing the government sector. So now I'm going to go back 2 charts. So just bear with me. The first chart is look at South Africa's corruption perception index. There's no doubt that South Africa has become a lot more corrupt. We are ranked 71st in the world, whereas if you go back 10 years, we were ranked around 40 to 50th in the world. 50th ranking is still not good. 70th is terrible. What the ranking says, if you look at our latest rating of 71, is that there are 70 countries in the world that are regarded as less corrupt than South Africa. That's significant. Now, I get some people when they see this chart, they say to me, geez, I thought South Africa's ranking would be way worse than this, given what we've read about in the press. What I think you're missing with that is that this is a very competitive set of countries. In other words, the world is corrupt. There are very few countries in the world that can brag that they have incredibly low levels of corruption. And when you look around the world, there are many more countries, believe it or not, that are way more corrupt than South Africa. That doesn't excuse South Africa in any way. 71 is not good enough. Now you take that number and add it to what we regard as our efficiency of government spending. In other words, let's say that government did have a lot more money. How efficient is government at spending the money? Turns out our ranking in world terms is over 100. In other words, there are more than 100 countries in the world that are regarded as able to spend more money, spend government money more efficiently than us. All of that would suggest to me exactly what Cyril's been telling us, and that is there has to be a cleanup within government. Government has to improve the levels of corruption, get rid of corruption. Government has to focus on improving the efficiency of spending, of making sure that we get rid of wasteful expenditure, and that instead of simply allocating more and more money to government, there would be, and there is, a focus on improving the efficiency of how government spends their money. So with that in mind, what's the answer to South Africa? How do we lift the growth rate? And in my head, the answer is very clear. It's just that it's politically difficult to get to that answer. The answer is you have to lift business confidence. So look at business confidence, and remember the business confidence number I showed you in the United States, which is pretty much at a record high. In comparison, South Africa's business confidence is well below average, well below what's regarded as the neutral level, and has generally been under pressure since the financial crisis. Now, in the chart I'm showing you, try find 2005 and look at the confidence level at that point. That confidence reading of around about 85 index points was the highest business confidence level ever recorded in this country. And if you go back to 2005, the country was buoyant, economic growth was vibrant, we were adding jobs, and importantly, we were undertaking investment, part of which was focused on the Soccer World Cup. That was a good time for South Africa, a good phase. We've lost our way in the last 10 years. Now, in order to lift business investment, we need confidence levels much higher. So I want to show you the most important chart I can show you about the South African economy at the moment. And in my head, it's the most important chart in this presentation. And that is the link between this number I'm showing you now, business confidence, and companies undertaking investment. So let's look at that relationship. I've put business confidence in purple, and I've put private sector investment in blue. And have a look at that chart. It goes all the way back to 1980. And what it tells you is there's a basic fundamental relationship between the two variables. In other words, if business becomes more confident, they will tend to invest. If the purple line goes higher, then the blue line follows. So if you Cyril and you the government and you want the growth rate in South Africa to move meaningfully higher, what have you got to focus on? You've got to focus on improving government efficiency, eradicating corruption, and lifting business confidence. And if we get business confidence higher, business investment will move. And if we get more business investment, what starts to happen is we employ more people. Once we do that, tax revenue goes up, social tension eases, and the economy performs much better. So that has to be the focus. So you can ask yourself, so why doesn't government simply do that? The problem for Cyril in just focusing on the business sector and in business confidence is that when he looks at the 2019 election, he's got a lot of constituencies he has to talk to. He has to talk to the South African Communist Party, COSATU, the Women's League, the Youth League. He's got to worry about the EFF. There are many voices that he has to listen to. So he can't simply devote all of his attention to business and the business sector. Clearly, it is an emphasis within his administration, and you can see that recently by the appointment of the 4 ambassadors to raise offshore finance. But he's got to make sure that all the participants are on board so that he can deliver an emphatic victory for the ANC in next year's election. So the situation is a little bit more complex than simply saying help business. He's got a broader constituency. With that in mind, with understanding how important business confidence is, think about the land issue. So let's just quickly talk about the land issue and then we'll end off. There's been a lot of debate about land and a lot of anxiety about land. And obviously a lot of that has been hyped up in the press. And I would actually lay the blame a lot in the government for this. The reason is the government put on the table, together with the EFF, this discussion about the need to change the constitution to allow for land expropriation without compensation, but they didn't frame that discussion at all. In other words, they just allowed that discussion to happen without some sort of framework or characterization as to where that discussion could go. The consequence of doing that is that there are many wild suggestions. There's many false information, false data on land ownership, and it's lead to a very heated, very emotional discussion. So let me give you our perspective, and this follows various meetings we've had with people in the ANC that are involved in the land debate and in other interested parties. And all I'm going to do is sketch you an outline of where we think the discussion's going. It's not as if this is a plan or this is what's going to come out of it, but it gives you a framework for the discussion. The first point of the debate is that in terms of changing the Constitution, Section 25, there's a strong discussion that says we may not have to do that. Section 25 allows for land expropriation not without compensation, allows for land expropriation if it's deemed to be in the public interest. What the Constitution says is that the compensation has to be fair, it has to be reasonable, it has to be just. It doesn't say a lot more than that. Up until now, the courts have assumed or have interpreted that as being a market-related value. So where the courts have entered into expropriation, they've awarded a market-related value for the property. What the ANC is tending to say is, let's test that in the courts. And it may not be that market-related value is actually the necessary outcome, and in some instances there may be exceptions to that without having to change the Constitution. So my sense of the discussion around changing the Constitution will end up being more, let's understand exactly what the Constitution says rather than simply assume we have to change the Constitution. And I think that's going to be the conclusion at the end of August this year. The second point to make on land is that I see in the press there's a huge focus on agricultural land and an assumption that actually an assumption that everybody wants to go farming. That's not the case. In fact, the debate on land redistribution is now focused very much more on urban land and not on rural land. There's more and more an understanding that the farming community has been under pressure. There are a limited amount of commercial farmers, and that where there are programs to encourage people to go farming, the uptake on those programs has been incredibly small. And that I think the effort's going to be much more on how do we get people access to urban land rather than start to disrupt the farming community. So I think that shift is very important. Within the focus on urban land, the types of suggestions around to me make a lot of sense. There is no indication whatsoever that government intends to start to simply expropriate somebody's house and therefore not pay compensation. That is so not what the government is trying to achieve here. There are actually a number of innovative steps that have been looked at in terms of accessing land better. So, for example, there's inner city absentee buildings where buildings have been left derelict. They owe the municipalities lots of money. Could that be used more effectively? There's an argument that says, let's look at informal settlements. Let's look at Diepsloot. Can we give people title deed living in Diepsloot? That has now become, in essence, a permanent structure. Can we do the same thing in other areas like Katlehong, Tokoza, Soweto, Alexander? There are lots of people that live in those areas that don't have title deeds, and getting title deed would help enormously with giving people an asset which can be leveraged. There's also an acceptance that the state-owned enterprises, particularly Eskom and Denel, own a huge amount of land. Some of that is arable land, and therefore you can use government land more effectively and you don't have to expropriate private sector land. There's also an acknowledgement that government owns at the moment somewhere between 3,000 farms and 4,000 farms. And therefore, if you want to go about expropriating farmland, don't bother. There are 3,000 farms government already owns. You can utilize that farmland much more effectively, and then look at how farm workers are treated in terms of have they got access to the land they've lived on for centuries. Yes, there are some suggestions on introducing a property tax, but my view is that that will focus on where people are hoarding property, where they have a second and third property, and there will be perhaps some look at that. So I don't think that the type of discussion that has been entered into around land is necessarily all that scary. My view is that the suggestions I've seen so far are actually sensible, innovative, some of them actually very clever. And I think that if government pursues this type of agenda, I think over time the fears that we see out there will ease off. What we urge in government is to get this debate out there much more urgently than simply allow all of this discussion to meander and create a whole lot of anxiety. That's more or less all I wanted to discuss for today. I know I've gone over time. I'm hopefully answered some of the questions with regards to the land issue. Obviously, we've got a question here, what's the hope for South Africa down the line? And we get this a lot. In other words, what do we think of on a 5-year view? My view is that there will be systematic progress from Cyril and his team in lifting confidence, both consumers and business. I think they've already made important strides in that direction, and I think that they'll add to that over time. I think we just got to be aware that Cyril is a very patient guy. He looks at these things methodically. He's not going to be rushing to decisions, but he has moved in the right direction. I think you'll see more of that move after the election next year. So I'm confident that South Africa will be in a position to lift the growth rate meaningfully. By that I mean 4%. On a 5-year view. I also think the credit rating agencies are now giving us a window of opportunity to get our house in order, and I think the risk of a downgrade has fallen away quite substantially. Obviously, the social dynamic of this country is urgent. We've got to address the high unemployment, the income inequality, the wealth inequality. The answer to that has got a lot to do with ongoing sensible transformation and ongoing focus on economic growth in order to raise employment. Ultimately, employment holds the key for the performance of the South African economy.
Thank you very much, Kevin. Thank you, Errol. That was very informative. Thank you very much for answering the questions. I see you covered all the questions that we got prior to the presentation. I'm just checking if there's any more that came in now. A lot of people saying thank you. Are there other people join? Okay, that's fine. Okay, a lot of people saying thank you, very informative. I'm just looking out for any important questions. A lot of it about the land, that's answered. What is your feels on the rand dollar rise and fall for 2018? You can think about that. The trend of US dollar in the next 1 to 5 years, what do you think about that? And then the last one, the gold price in USD in the next 1 to 5 years also. So you can maybe think about those three questions and give us a roundabout answer before we close off.
Just quickly on the rand, obviously the currency has done really well since Cyril was elected. And there's no doubt that the strength of the rand directly relates to the political changes and also relates to the credit rating agency Moody's deciding to keep us on investment grade. In the short term, there's no reason to expect the rand to come under significant pressure. There's a lot of interest in South Africa from a foreign investor point of view. South Africa's growth uplift looks more encouraging. And at the same time, we're finding that in general, foreign investors are still favoring emerging markets. They like our interest rates. They like the fact that they can get a return of 8 or 9% in South Africa compared with 2 or 3% in the United States. So in the short term, I think the rand can hold on to current levels. Over the medium term, so now we're looking more on a 5-year basis, we've got to understand that as South Africa grows, it tends to draw in more imports. Obviously, our inflation rate is higher than our trading partners, and so we would anticipate the rand coming under some pressure on a 5-year view. We can't expect the rand to remain at these levels forever. But that depreciation of the rand, we do think is in the order of around 5% a year as opposed to anything dramatic. So as long as the politics is good, as long as the economy is moving in the right direction, the rand will reflect that environment. In terms of the gold price, it has moved up a little bit, but overall you would say it hasn't proved to be the type of investment many people hoped for. And obviously the gold price tends to respond more when there's a higher degree of uncertainty in the world economy. That uncertainty can come about through the trade wars. It can come about through tension with North Korea. It can come about through the attacks in Syria. So our view is that, yes, we will see more of those types of events. There will be a general tendency for gold to move slightly higher, but it's not as if we have filled up our portfolio with gold holdings. We find other more attractive investments that we think will outperform.
Thank you very much, Kevin. That's covered. Ladies and gentlemen, if you have any more questions that you think up of because we're out of time, please do send them on the email that you get on your thank you note, and I will forward it in the right direction for you and get the responses sent to you. If you're keen or interested in a financial planner contacting you, please visit our nearest Standard Bank branch that's nearest to you, or on the thank you note that you will receive in a few days or tomorrow, there is a contact number that you can send a request there, and a financial planner will be in touch with you. On the invite as well that you got, there are dates of the upcoming webinars for next month and the following month. So look out for those and diarize those. Those will be very interesting as well. Thank you very much for taking out your hour to come sit with us. We hope it was informative and as great as we had anticipated it for you. Okay, thank you very much. Have a good afternoon, and we'll see you on the next webinar.